Subscribe to my channel Report Stock.
Welcome to the deep dive. This is where we, really get into the details behind the headlines. Today, we're looking at United Maritime Corporation. They've just put out their latest financial results and talked about some big strategic moves. So our mission really is to sift through all that information, the Q2 and first half 2025 report. We want to pull out what's actually important, figure out what it means for them, and, maybe the wider shipping world too. We'll try to keep it clear, avoid the heavy jargon, and really focus on the so what behind all the numbers.
Exactly. And we're mostly working off their official release. So that's the financial tables, the CEO statement, fleet details, all that stuff. Our job is to kind of connect those dots for you, give you the full picture of what's really going on with the company.
Okay, let's do it. Diving straight in then. The financials, what are the sort of headline numbers, the standard JAP figures? How did United Maritime actually do in Q2 in the first half?
Well, if you look at Q2 first, the headline's actually a bit positive. Net revenues were up slightly, $12.5 million versus $12.4 million last year. And net income improved too, $1.0 million compared to $0.7 million. Basic EPS, that's earnings per share, also climbed a bit, 0.11 cents from $0.08.
Okay, so Q2 looks
yeah, on the surface. But then you look at the first half of 2025, and it's, well, a different story. Net revenues dropped down to $20.2 million from $23.7 million, and the net loss got bigger. It was $3.5 million compared to just $0.7 million loss in the first half of 2024. So the EPS loss deepened to minus $0.40 versus a minus 0.08.
Okay, so a bit of a mixed bag there. Quarter looks better, half year looks tougher.
Pretty much.
Now, you mentioned those GAAP numbers, but reports like these often have adjusted figures too, adjusted net income, adjusted EBITDA. Why do they do that? What are these non-GAAP numbers supposed to tell us that the standard ones don't?
Right. So think of the GAAP numbers as the official accounting picture, including everything, even one-offs. Non-GAAP measures like adjusted EBITDA, they try to give you a clearer view of the ongoing business performance. They strip out things that aren't cash, like stock compensation, or, items that might swing wildly year to year, like gains or losses from consolidating a venture.
Okay, so more about the core operation.
Exactly. Especially EBITDA earnings before interest, taxes, depreciation, and amortization. For a shipping company with lots of assets, it's a really key metric. It's sort of a proxy for the cash flow coming just from running the ships before financing costs or, the depreciation of the vessels themselves.
And what do those adjusted figures show for United Maritime?
Well, that's where it gets interesting again. For Q2, adjusted net income actually decreased $0.2 million, down from $0.9 million. And adjusted EBITDA fell too, $5.1 million from $6.3 million. And for the first half, the adjusted net loss got wider, $4.2 million versus $0.2 million. And adjusted EBITDA dropped quite a bit, $6.0 million from $10.0 million.
Okay. So even though the standard Q2 profit looked better, these adjusted numbers suggest the underlying operational performance maybe faced more pressure.
That's a fair way to put it, yeah. It suggests the core earning power might have weakened compared to last year, even with that slight GAAP profit in Q2.
Right. Let's switch to the operational side then. The TCE rate, time charter equivalent. That's basically how much a ship earns per day, right?
Yeah.
Why is that so important, and what's the story there?
You got it. TCE is crucial. It tells you how well they're actually doing at earning money with their vessels day to day. Now, the report shows the overall TCE rates for Q2 were $15,421 a day, and for the first half, $12,744. Both of those are lower than the same time in 2024, so year over year, a decline.
Okay, lower earnings per day.
But, and this is a big but, the CEO made a specific point. He highlighted that the Q2 daily TCE was actually up 55% compared to Q1 of this year.
Whoa, 55% quarter over quarter.
Exactly. So, while the year-on-year comparison isn't great, that sharp jump from Q1 to Q2 is, well, significant. He said it confirms the strength of the dry bulk rebound and our ability to capture the upside.
I see. So it suggests they were able to really take advantage of improving market conditions within the year, even if the average is still below last year. That shows some agility.
Precisely. It's a key detail that puts the year-over-year decline into perspective, shows they can react quickly.
Okay, good point. Now, beyond earnings, what about the balance sheet? Cash, debt. How's the overall financial health looking?
Well, cash on hand was down a bit, $3.4 million at the end of June compared to nearly $6.8 million at the end of last year.
less cash.
Yes, but on the flip side, they made some real headway on debt. Long-term debt is down significantly to $83.8 million from almost $98 million. That's quite a chunk paid off.
That is significant deleveraging and shareholder equity.
Pretty stable, around $60.3 million. Now, looking at cash flow, cash from operations was down quite a bit, but cash from investing activities saw a big positive swing, which hints pretty strongly at the asset sales we're about to talk about, cash coming in from selling things.
Got it. Okay, so the numbers paint this picture of, some challenges, but also some recovery and definitely some big moves on the debt side. Let's talk about the strategic moves now, because that often tells you more about where a company thinks it's going. First up, shareholder returns. They declared another dividend, right? The 11th one in a row.
That's right, a $0.03 per share quarterly cash dividend for Q2. And yeah, it's their 11th consecutive one. Since they started this back in November 2022, they've declared $0.65 per share in total dividends. That adds up to $13.1 million they've returned to shareholders.
That seems like a strong commitment, especially given the mixed results we just talked about. What does that signal?
I think it signals confidence. The CEO explicitly called it a clear signal of confidence in the outlook and our consistent return policy. It says management believes in the company's ability to generate cash going forward and wants to reward shareholders consistently.
Okay. And alongside paying dividends, they've been busy changing their fleet too, selling ships. What's the plan there?
Yeah, very active on that front. It's called fleet optimization. They sold their oldest Cape-size vessel, those are the really big ones, the MV Gloria ship built back in 2004. They got a net price of $15.0 million for it in June.
Selling off the older assets. Makes sense.
Exactly. And they also agreed to sell another one, the MV Trader ship, built in 2006, for $17.8 million. That sale should close in August, and they expect to book a profit of about $1.5 million from it in Q3.
So why sell now? Just getting rid of older ships, or is there more to it?
It seems strategic. They're explicitly capitalizing on strong secondhand values. Basically, the market price for used ships is good right now, so they're taking advantage. These sales are expected to free up around $17.9 million in cash after they pay off the debt associated with those ships. And they say that cash will strengthen reserves and let them pursue new opportunities.
Okay, so freeing up cash, maybe reducing the average age of the fleet.
Right. And it means their fleet goes from 7 ships down to 6 once the trader ship is delivered. They also mentioned extending the charter on another vessel, the MV Nizia, so it's, active management all around.
Interesting. And speaking of new opportunities, this next bit caught my eye. They're moving into the offshore sector, an energy construction vessel project. That sounds different. What's that about?
It is different and quite fascinating. They increased their ownership stake to about 32% in a Norwegian company that's involved in building a new offshore energy construction vessel, an ECV.
An ECV. So that's for, building offshore wind farms or oil rigs?
Yeah, complex offshore energy project. It's a very different market from hauling, say, iron ore or grain in a bulk carrier. They funded this partly with a short-term loan, which they've already paid back. And because they increased their stake, they now have to fully consolidate the joint venture onto their own books. That actually resulted in an accounting profit of $1.3 million.
Wait, a profit just from increasing their stake? How does that work?
It's an accounting thing, not operating cash. When they gained control and had to consolidate, they had to revalue their original, smaller investment up to its current fair market value. That difference gets booked as a non-cash gain.
Ah, okay. So why this move? Why offshore construction?
The strategy, according to them, is to diversify earnings and risk exposure. They're moving into a segment they see as having strong market fundamentals, driven by all the investment going into oil and gas infrastructure right now. And interestingly, the CEO added that the current market value of this ECV they're building is actually estimated to be higher than what they're paying for it under the contract. So they see potential upside there, too.
Okay, diversification into a potentially strong but different market. That's a big strategic shift.
Definitely a significant move.
So bringing it all together, the financials, the dividends, the ship sales, this offshore venture, what's their outlook now? What are they telling us about Q3 and the broader dry bulk market?
Well, for Q3, they've given some guidance on their expected TCE rates. They have about 68% of their operating days already fixed at an estimated rate of $15,495. Based on that, they anticipate their overall TCE for Q3 will be around $14,707 per day, which, sounds reasonably healthy.
And their view on the wider market, you mentioned the rebound earlier.
Yeah, the CEO sounds pretty positive about the dry bulk market overall. He specifically mentioned that both Capesize and the medium-sized Panamax segments rebounded sharply from the seasonal weakness of the first quarter. He pointed to more grain and coal shipments boosting the Panamax ships, and strong iron ore and bauxite exports helping the Capesizes.
So demand seems strong. What about the other side of the equation, the supply of ships? Is that looking tight? And how do environmental rules play into it?
That's the other key piece, and it looks favorable from a ship owner's perspective. The order books, the number of new ships being built, are described as modest. Only about 8% of the current Capesize fleet and 14% of the Panamax fleet are on order.
So not a flood of new ships coming soon.
Doesn't look like it. Plus, you have an aging fleet. Around 7% of Capesizes and 16% of Panamaxes are over 20 years old. And crucially, as you mentioned, environmental regulations are getting stricter. The report says these are effectively tightening vessel supply because older, less efficient ships become more costly or even impossible to operate competitively.
Right, taking older ships off the water faster.
Exactly. So the CEO's conclusion is pretty clear. This combination of a tight supply picture and robust cargo flows gives them conviction that dry bulk markets are structurally positioned for strength into 2026. He does acknowledge volatility, the market is always up and down, but he stresses the resiliency the market has shown, even with all the macroeconomic uncertainty lately.
Okay, so potentially strong market ahead, driven by decent demand and tight supply. That's the backdrop for all these moves. So to wrap this all up then, what's the big picture strategy for United Maritime? What's the main thing you think listeners should take away from this deep dive?
I think the main takeaway is seeing a company actively managing its situation in a really dynamic market. They're trying to balance things. On one hand, consistent shareholder returns through dividends. On the other, smart fleet management selling older ships when prices are good. And then, importantly, diversifying into a new area offshore to potentially boost future earnings and reduce reliance solely on the volatile dry bulk market. They're positioning themselves basically to handle the present while building for what they hope is a stronger market into 2026. It's about adaptation and calculated bets.
Yeah, it really does feel like a company in motion, doesn't it? Adapting, optimizing, diversifying. Their own summary phrase seems apt. Generating strong near-term cash flows and unlocking long-term value through disciplined capital allocation across dry bulk and offshore sectors. So, it definitely shows they're not just sitting still. So, as you digest all that, here's something to maybe chew on. We know the dry bulk market is famously volatile, right? Always has been. And now United Maritime is putting more chips on the table in the offshore sector. How might that constant tension balancing the need for those immediate cash flows from today's operations against the push for long-term value, perhaps through diversification, how might that balance continue to shift for them? And what could that mean not just for United Maritime, but maybe for how other shipping companies think about their own futures too? Something to consider.
Subscribe to my channel Report Stock.